Hi, what I'm going to talk in this video is what is ARR or accounting rate of return. Accounting rate of return, which is also known as average rate of return, is used to measure the expected profitability for any capital investment. So it's an accounting matrix that is used to judge the profitability of an investment. It can also help investor analyze the risk involved in the investment and to sort of draw conclusions about the investment, whether the investment will generate sufficient returns to cover for the risk that it involves. So it's basically used for capital budgeting. So ARR is a matrix that is used for capital budgeting, and we'll see how it can be used, what the advantages and disadvantages of using ARR for capital budgeting. So how do we calculate the accounting rate of return? Well, accounting rate of return is a very simple formula, right? We can use it's just average accounting profit divided by the average investment. So accounting profit is something that you will obviously calculate taking into account the revenue and the cost. But average investment is somewhat confusing, but it's simple to calculate. Is basically the sum of the opening and the closing book value of the project divided by 2. So it starts with the opening value of the book plus the closing value, right? And then divided by 2. That's basically your average investment. Okay, so it's basically profit divided by the in the investment made into the project, and you take the average of both, divide, and what you get is the ARR. And it's just a simple arithmetic average, nothing complicated. All you need to know is just to how to calculate your average accounting profit and average investment. So these are the two most important things. Otherwise it's just a simple formula. And where exactly it's used? So it's basically used in capital budgeting, as I said, but most importantly to compare the return on investment or the profitability of two different projects. And when it is a question of which project to go with, ARR is actually very helpful because the one with higher ARR is more profitable, and therefore it's very important that we go with the that project where we have higher ARR. So yeah. All right, so there's one thing to remember: the calculation of ARR not only has to be completed before the proposal is accepted, but also the income of the project is checked year by year, because the ARR does not consider multi-period variables in the calculation. So this is very important. ARR does not consider the multi-period variable in the calculation. That means if the project starts at time T1, you will obviously have the ARR in place, but that does not tell you everything about the project. During the course of the project, right, in T2, T3, T4, you'll also have to check the income in order to monitor the return that you're getting from this project. So what the advantages are is a very simple way, right? So its simplicity is the best to sort of analyze the potential return that one can have from the project. It's very easy to calculate. So simplicity is its biggest advantage. It shows the profitability of investment and helps to measure the current performance of the project. So yeah. And the second most important thing is that when you have option of choosing one of the most important projects from a number of projects, or probably you have to select the most profitable projects out of a number of ideas, a number of project proposals. This is very useful because you can easily calculate the ARR and then compare. So it makes your life easy when it comes to selecting the most important projects. And for small investors, this is very important because it costs them less money in order to make a decision. So and also you do not need lot of heavy or highly complicated, sophisticated mathematical technique. Anyone can do it, right? So all right, so what's the disadvantages? So there are few disadvantages, and the disadvantages are mostly related to especially the large investors, not the smaller ones. For small investors, I think it's a very good metrics. For large investors, probably less good metrics. So it doesn't consider taxes actually. That's an important factor, right? The taxes play a big role in the profitability, and especially with higher returns, you have higher taxes. So that's something it completely ignores, and it's one of the weakness of this methodology. Um, and this method cannot be used where the investment in a project is made at a different point of time. That means you don't make investment decision just at the beginning of the at T1. That means at the beginning of the project. You also could have decision T2, T3, T4, and so on. That means during the course of the project, you have different investment decisions. If that is the case, then ARR is of very little use. So this is another weakness of this technique. One of the most important disadvantages of this technique is that it ignores the time value of money. It does not take into account the time value of money. And time value of money is very important in finance and accounting, but unfortunately this technique does not take that into consideration, and therefore it's a very big issue, especially if the investment is big ticket. When comparing different projects, the method does not consider validity period of various investments. So yeah, it also does not consider the amount of time actually the project will be. Will it be for 3 years, or 5 year, or 10 years, right? And if it is for a very lengthy period of time, the risk involved is much higher. So when the risk is very higher, you expect higher return or higher return and so on. So that factor is not something that is captured in ARR. So ARR will not tell you the expected return for a longer horizon. So that's another weakness. But so it's not very suitable for large and long-term projects, but certainly very suitable for smaller projects. One example we like to give. So here is this example. So I've got a project which has got an average return of 20,000, and the investment made is 100,000. The ARR is just 20%. Another example here is two projects, one with a unexpected annual profit of 40K, and proposal to the expected annual profit of 30K, and then you have investment value respectively 140K and 100K, and the ARR comes out to be 29% and 32% respectively. So proposal 2 is having an advantage over proposal 1 because it is more profitable, right? So that's the way we basically compare the profitability of two different projects.